As of the most recent quarter, 5 publicly traded U.S. technology companies now account for over 30% of the total market capitalization of the S&P 500. That number is real, it is current, and it is not a forecast. It means that nearly 1/3 of what is widely considered the market is now concentrated in a handful of firms whose valuations are tied, directly or indirectly, to artificial intelligence expectations. This is not unprecedented, but it is historically specific. At moments like this, risk does not announce itself with panic. It appears quietly, through concentration, through correlation, and through narratives that feel mathematically reasonable, until the structure underneath them shifts. While public discussion focuses on daily price movements, product announcements, and optimistic earnings calls, something else is happening in parallel. Large institutions are not issuing dramatic warnings. They are not publishing alarmist headlines. They are adjusting exposure slowly. They are lengthening time horizons. They are increasing selectivity rather than enthusiasm. This movement is subtle. It rarely trends on social media, and it almost never arrives with urgency. Before we continue, welcome to The Finance Historian. If this is your first time here, let me know in the comments where you're watching from. If you find this kind of calm, historically grounded analysis useful, consider pressing the like button and subscribing. It helps the channel reach others who prefer understanding over noise. By the end of this video, you will understand 3 things. First, what is happening beneath the surface of the AI stock boom. Second, why this phase feels familiar to anyone who has studied financial history. And third, what typically follows next when similar conditions have appeared before. Not as a prediction, not as advice, but as pattern recognition. Financial history does not move in straight lines. It moves in cycles. These cycles are not driven by emotion alone. They are driven by capital constraints, technological diffusion, labor adaptation, and time. Over centuries, across empires, markets, and innovations, the same structural sequence appears again and again. A new technology emerges. It promises productivity gains. Capital flows toward it aggressively. Valuations detach from near-term cash flows. Infrastructure lags behind expectations. Returns concentrate early. Then normalization begins. This is not a political pattern. It is not ideological. It is mathematical. To understand whether AI stocks resemble the dot-com bubble, we must first understand the cycle itself, independent of any specific technology. Let's outline it clearly. The repeating capital innovation cycle. This cycle has appeared with canals, railroads, electricity, automobiles, radio, the internet, and now artificial intelligence. It unfolds in 5 structural stages. Each stage has a characteristic behavior. Each stage tends to last a predictable range of time. And each stage feels different from the inside than it looks in hindsight. Stage 1, breakthrough recognition. A genuine technological advance becomes visible, not theoretical, demonstrable. In the late 1990s, it was the commercial internet. Today, it is machine learning models that outperform humans in narrow cognitive tasks. Capital initially hesitates, then it moves quickly. At this stage, typically lasts 2 to 4 years. Stage 2, narrative expansion. The technology's potential becomes the story. Revenue matters less than reach. Profitability is deferred. Valuations are justified by total addressable market. This is where language changes. Could replaces does. Eventually replaces currently. Discount rates shrink in the collective imagination. This stage can last 3 to 6 years. Stage 3, capital concentration. Money stops spreading evenly. It pools. A small number of firms capture most of the investment, attention, and valuation growth. Index performance becomes dependent on fewer and fewer names. This is where we are now. Historically, this stage lasts 1 to 3 years. Stage 4, constraint recognition. Limits appear, not always crashes, sometimes bottlenecks, sometimes regulation, sometimes margins. Reality reasserts itself slowly. This stage can take 2 to 5 years. Stage 5, normalization. The technology remains. The excess expectations do not. Winners survive, valuations compress, returns align with cash flow rather than narrative. This stage is often misremembered as failure. In reality, it is maturation. Now, let's look at history, because this exact sequence has already occurred multiple times. In 1995, fewer than 20% of US households had internet access. By 2000, the number was over 50%. The technology was real. The productivity gains were real. But capital moved faster than adoption. Companies with no earnings reached billion-dollar valuations. Index concentration increased sharply. In 2000, the top 10 stocks made up over 25% of the NASDAQ. Then constraints appeared. Bandwidth limitations, unprofitable business models, rising interest rates. The result was not the end of the internet. It was the end of the narrative phase. From 2000 to 2002, the NASDAQ fell nearly 80%. Yet, over the next decade, companies like Amazon and Google emerged stronger after normalization. In the 1840s, railroads were transformative. They reduced transport costs dramatically. They expanded markets. Capital flooded in. By the 1870s, the U.S. had overbuilt rail capacity relative to demand. Returns collapsed. But railroads did not disappear. They became infrastructure, stable. Lower growth? Essential. At the turn of the 20th century, electrification sparked massive investment. Speculation followed. By the 1920s, valuations had surged, then normalized. Electricity became a regulated utility. Returns stabilized. Innovation continued quietly. In each case, the pattern is identical. Now, let's return to the present. AI is not imaginary. Its applications are measurable. But current valuations assume rapid, broad, and uninterrupted monetization. At the same time, institutions are behaving cautiously. They are funding infrastructure. They are hedging exposure. They are differentiating between tool makers and end users. This suggests we are not at the beginning of the cycle, nor are we at the end. We are in stage 3, capital concentration, moving slowly toward stage 4, constraint recognition. Not tomorrow, not suddenly. Gradually. What typically follows is not collapse, but adjustment. Margins compress, growth slows, expectations recalibrate. For individuals, this phase rewards awareness, not fear, not speculation. Understanding where we are in the cycle allows preparation without panic. Artificial intelligence feels fundamentally different from past technological waves, not because it is faster, not because it is more complex, but because it appears to touch cognition itself. That perception matters. Historically, technologies that seem to replace human judgment attract capital more aggressively than those that merely replace labor. The internet replaced distribution. Railroads replaced distance. Electricity replaced muscle. AI appears to replace thinking. That distinction intensifies expectations, but history suggests that perceived uniqueness is often a feature of stage 2 narratives, not a structural break from the cycle. To understand this clearly, we need to separate capability from economic constraint. AI systems today demonstrate impressive performance in narrow domains: language generation, pattern recognition, prediction within defined data sets. These are real advances. However, economic systems do not reward capability alone. They reward scalable, durable, margin-positive integration. This is where historical comparison becomes useful. During the late 1990s, internet advocates made a similar argument. They claimed the internet would eliminate transaction costs entirely, that it would flatten competition, that first movers would dominate indefinitely. Some of that proved true. Much of it did not. The limiting factors were not technological. They were economic. Distribution costs fell. Customer acquisition costs rose. Competition intensified. Margins compressed. The same dynamic is beginning to appear in AI. Training large models is capital intensive. Inference costs are ongoing. Energy requirements are non-trivial. Data advantages erode over time. These are not fatal flaws. They are constraints. And constraints define the transition from narrative expansion to return normalization. Another difference often cited is speed. AI adoption appears faster than internet adoption. This is accurate, but faster diffusion compresses the cycle rather than eliminating it. When technologies spread quickly, competition arrives sooner. Pricing pressure emerges earlier. Differentiation becomes harder. In historical terms, speed reduces the duration of excess returns. That is a structural insight, not an opinion. Let's look again at institutional behavior. While headlines focus on consumer-facing AI tools, institutional capital is behaving differently. Pension funds, sovereign wealth funds, large endowments, they are not broadly increasing equity exposure to AI narratives. They are reallocating toward infrastructure, energy, and enabling layers. Data centers, semiconductors, power generation, network capacity. This mirrors past cycles precisely. During the railroad boom, institutions owned land and steel. During electrification, they owned utilities and grids. During the dot-com era, they eventually shifted toward backbone infrastructure. This is not because institutions lack imagination. It is because they understand where durable cash flows emerge once narratives fade. At this point in the cycle, public markets tend to reward visibility rather than resilience. That is temporary. Now let's examine the dot-com comparison more directly, without analogy or exaggeration. In 1999, the top 5 technology stocks accounted for roughly 18% of the S&P 500. Median price to sales ratios exceeded historical norms. Profitability was widely deferred. Capital was cheap. Volatility was suppressed until it wasn't today. A small group of AI-adjacent firms dominates index returns. Valuations reflect long-duration growth assumptions. Profitability is concentrated, not widespread. Capital costs are rising, not falling. Volatility remains episodic rather than systemic. This is not a mirror image, it is a rhyming structure. Importantly, the dot-com collapse did not occur because the internet failed. It occurred because expectations exceeded the system's ability to monetize those expectations in the required time frame. That distinction matters. AI faces a similar test. Not will AI work, but can AI generate returns at the scale and speed currently implied? History suggests this question is answered gradually, not suddenly. Before we go further, take a moment to like the video and subscribe to The Finance Historian if this analysis is useful. It signals that there is an audience for context, not just commentary. Now, let's examine time, the most underestimated variable in financial cycles. Most bubbles are not created by false ideas. They are created by correct ideas with incorrect timelines. Railroads were transformative, but not instantly profitable everywhere. Electricity reshaped economies, but required decades of infrastructure. The internet changed commerce, but took years to align business models with reality. AI will likely follow the same path. The economic benefits will accrue unevenly, early returns will concentrate. Late adopters will compete on thinner margins. This leads to a familiar outcome. Investors confuse technological inevitability with investment inevitability. History repeatedly demonstrates that the two are not the same. The most important insight is this: bubbles are rarely recognized by absurdity. They are recognized by overconfidence in linear extrapolation. When growth curves are assumed to continue uninterrupted, when constraints are treated as temporary rather than structural, when concentration is mistaken for stability. At this stage of the cycle, the system has not broken, but it is tightening. Capital is becoming more selective, cost of capital is rising, regulatory attention is increasing. These are signals of transition. To understand whether AI stocks resemble a dot-com style bubble, we must avoid prediction and focus instead on positioning. Where are we now? Not emotionally, not narratively, but structurally. History becomes useful when it allows us to place the present inside a known sequence. Let S return to the 5-stage capital innovation cycle and map it directly onto today on the S AI landscape. The breakthrough phase for modern AI did not begin with consumer chatbots. It began earlier. Between roughly 2012 and 2018, machine learning models began outperforming traditional systems in image recognition, language translation, and pattern detection. This period was quiet. Capital flowed primarily through venture channels. Public markets paid limited attention. Returns accrued slowly. This is typical. Breakthrough phases are rarely celebrated in real time. They are technical. They are uncertain. They are expensive. The narrative phase accelerated rapidly after 2020. Computing power increased. Data availability expanded. Model performance crossed visibility thresholds. At this point, the story shifted. AI was no longer a tool. It became a platform. Language changed. Augmentation became replacement. Assistance became automation. Productivity gains became economic transformation. This shift matters because narratives influence capital allocation faster than balance sheets. Public market valuations began reflecting not current earnings, but assumed future dominance. This is not unusual. It is a repeatable historical response to visible technological inflection points. This is where the present becomes identifiable. In nearly every past cycle, the moment of greatest confidence coincides with narrowing leadership. The majority of returns come from a small group of firms. Index performance becomes fragile to individual names. Correlation rises beneath the surface. This is measurable. Today, a limited number of companies account for the majority of AI-related equity gains. They share several characteristics: high visibility, strong balance sheets, control over critical infrastructure, narrative alignment with AI adoption. This concentration creates an illusion of safety. When leaders rise steadily, volatility appears low. But structurally, risk increases as diversification declines. This exact dynamic preceded corrections in 1929, 1972, 2000. Not because markets were irrational, but because they became narrow. This is an important distinction. Markets do not fail when investors are wrong. They destabilize when investors agree too much. Public narratives are loud. Institutional behavior is quiet. When we observe pension funds, insurers, and sovereign wealth funds, a pattern emerges. They are not abandoning AI. They are reframing exposure. Rather than chasing equity upside, they are allocating toward semiconductor fabrication, power infrastructure, data center real estate, energy supply chains, networking capacity. These assets sit beneath the AI narrative. They are less sensitive to sentiment. They benefit from adoption, regardless of which software firm dominates. This is not defensive behavior. It is late-stage cycle behavior. Historically, institutions do this when upside remains, but risk asymmetry increases. They are not predicting a collapse. They are acknowledging constraints. In past cycles, the transition from stage 3 to stage 4 is gradual. It does not arrive with headlines. It appears through friction. In the AI ecosystem, those frictions are becoming visible. Energy demand is rising faster than grid expansion. Model training costs are escalating. Marginal performance gains are becoming more expensive. Regulatory scrutiny is increasing globally. Enterprise adoption is slower than consumer excitement. None of these negate AI's value. They slow its monetization curve. History shows that when monetization slows while expectations remain elevated, markets adjust, not emotionally but mechanically. Discount rates rise, future cash flows are reevaluated, valuation multiples compress. This is not collapse, it is recalibration. The most misunderstood aspect of the dot-com era is timing. The internet boom did not end because usage declined. Usage exploded. What ended was the assumption that usage automatically translated into profits on a predictable timeline. The same question now faces AI. Not will AI be used, but who captures the value and when? History suggests that early narratives overestimate both speed and concentration of value capture. Value eventually spreads. Margins normalize. Returns become incremental rather than exponential. This is not failure. It is maturation. At this point in the cycle, the most common mistake is emotional interpretation. Optimists see inevitability. Skeptics see bubbles. History sees phases. If this framework is helping you see the current moment more clearly, take a moment to like the video and subscribe to the Finance Historian. It allows us to continue examining long-term patterns without urgency or fear. When financial cycles resolve, they rarely do so with a single event. History teaches this consistently. What most people remember as a crash is usually the visible midpoint of a much longer adjustment that began years earlier and continues years afterward. The more common outcome is slower, more subtle, and more structural. Once constraint recognition begins, the system enters a phase where expectations and reality are slowly forced back into alignment. This alignment happens through trade-offs, not through collapse. Let's be precise about what those trade-offs typically look like. In nearly every prior innovation-driven cycle, the same pressures emerge. Capital becomes more selective. Funding does not disappear. It becomes conditional. Projects with unclear monetization timelines struggle. Projects with infrastructure relevance endure. Margins compress. Competition increases as the technology becomes accessible. Early advantages narrow. Pricing power weakens. Narratives fragment. There is no longer a single AI trade. There are subsectors. Winners and laggards separate. Returns normalize. They do not vanish. They resemble traditional business returns rather than exponential ones. This is the phase where public attention fades. Ironically, this is also when the technology becomes most useful to the real economy. The internet did not reshape commerce in 1999. It did so quietly between 2003 and 2013. Electricity did not transform factories at the moment of peak speculation. It did so once systems were rebuilt around it. AI is likely to follow the same pattern. The economic impact may arrive after the financial excitement. At this stage, outcomes are shaped less by innovation and more by systems. Energy availability, labor adaptation, regulation, capital costs, organizational integration. These are slow-moving variables. They do not trend on social media, they do not generate excitement, but they define return profiles. For AI, the binding constraints are becoming clearer. Energy and compute costs anchor scalability. Data quality limits marginal improvement. Human workflows adapt unevenly. Legal and ethical frameworks lag deployment. None of these stop progress, they pace it. And pacing changes valuation mathematics. History does not suggest panic, it suggests positioning of mindset. In late cycle innovation phases, the most resilient individuals share three traits. They prioritize adaptability over certainty. They expect change in narratives. They remain open to revision. They distinguish between technology and investment. They understand that widespread usefulness does not guarantee extraordinary returns. They focus on skill and awareness rather than speculation. They prepare for environments where growth is uneven, not explosive. This applies whether one participates directly in markets or not. Technological shifts reshape labor, institutions, and opportunity structures long before they settle into financial equilibrium. Being aware of the phase allows calm adjustment. The dot-com era is often remembered as a warning. That framing is incomplete. It was also a foundation. The excesses funded infrastructure. The failures clarified models. The survivors built durable systems. AI appears to be approaching a similar inflection, not an ending, a transition, from narrative dominance to economic integration, from concentrated excitement to distributed utility, from exponential expectations to compounding reality. This transition does not require belief. It does not require fear. It requires recognition. History rarely repeats in headlines. It repeats in structure. And that structure is already visible, quietly, gradually, inevitably. If this long-form, historically grounded approach adds clarity in a noisy environment, take a moment to like this video and subscribe to the Finance Historian, not to predict the future, but to understand the patterns that continue to shape it.